afternoon, ladies and gentlemen. Welcome back. I hope you guys are ready for a very, very eventful afternoon with Powell. We are going to be getting the interest rate decision at 2 p.m. So in about a half hour from now, and then we're going to get that Q&A session at 2:30 p.m. It's going to be wild. I mean, this is what we really need to see in order to kind of determine where the market's going to go next. We do have non-farm payrolls on Friday, which is going to be very important. Just showing us a little bit more about what the jobs market's looking like. So going into the end of this week, we do have some really, really important data points. Now, again, for some of the trades that we need to be looking for, we're kind of waiting for the market to just hand us those A plus setups again. Again, as you guys all know, it's incredibly simple finding stocks that are about to explode before they do, if you are able to have that patience to wait for the stocks to actually show you that they're ready to explode, because that's exactly what they're going to do every single time. But team, I mean, we can do this again. It is that time of day, ladies and gentlemen. Make sure you say good afternoon to somebody in the live chat. If you guys would like to say good afternoon to me, I'd love to receive some good afternoons. As always, ladies and gentlemen, make sure you guys are hitting that like button on the way in. For what do you call it? This week and all of July, we're going to be live every single day in the mornings on YouTube. As you guys all know, the premium Discord's coming out for those of you guys in the educational programs at the end of August. Everybody that takes advantage of those deals, well, the 40% off deal ends today, which is going to give you that free access there. That ends today. Links at the top of the live chat, codes STV40. But again, team, let's see who's in here. Make sure you guys are dropping likes. Let's have a good FOMC day, huh? Let's do it. Let's do it, ladies and gentlemen. So, yeah, NEE 40%. Ryan, what's going on, guys? Eddie, Yuki, David, Dale. Let's see who else we got in here. We got what? Decent amount of people in here so far. Let's see who we got. Anybody that's returning after a long time. I don't know where you guys been, but we've been printing money left and right. NEE looks really good. So this is the one that I've been hunting. We've been talking about again, utilities. The utility sector has been looking good, along with real estate, banks, financials. NEE has been one that, I mean, I couldn't get right back in here. This was a tough one. The setup was kind of there. It wasn't really there. I mean, you could kind of see it forming in here. This looks perfect. So because of that, I got a little bit more time on these contracts, but this is looking really, really, really good so far. We'll see what happens after FOMC, but I wouldn't expect a whole lot to be changing. So let's see. To quote Powell, good afternoon. What's going on, team? How we doing? Let's see. So I mean, the market, this is the other issue that I have. The market's already up 1.4% on the day. Unless Powell comes in and is like very dovish and comes out with some really good reasons for this market to continue up. I mean, I would almost expect this to be a dud of a meeting. I think the one other important thing that we do have to listen for is Powell, what Powell thinks now about GDP, because the expectation for the full year is about 2.1% from the Fed's summary of economic projections. I think first quarter was like 1.4, second quarter was like 2.7, 2.8. So you are kind of averaging out in there. We were talking about the fact that, well, I mean, coming in at 1. I think it was 1.4, really low for Q1. We would have needed to see some significant growth in order for the Fed to get to that 2.1% expectation for GDP this year. So wouldn't expect a whole lot to change there. I mean, how they reference some of the jobs data is going to be interesting too, because we know that a lot of those numbers are not being reported correctly. It's making it seem like things are way better than they are, even though there's a wild amount of full-time job loss and is being masked by those part-time job gains in those jobs reports. So let's see. What about Kava calls? We can take a look. Gold. We talked about gold this morning. I don't like how gold looks right now for any swings. I do think it's gonna go. I do think that gold is gonna continue up, but we'll talk about that in a second after Kava. I mean, I haven't looked at Kava in a while. You take a look here. Kava and CMG. Kava's starting to set up actually. It does have earnings in 2 weeks, but this is one that I'll keep on my radar here. So Kava doesn't look that bad. Chipotle is another one. Yeah, if Chipotle can flatline from here, I'm going to be very, 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 very interested in Chipotle. And then we can take a look at GLD gold. I mean, again, I do think this is going to continue up, but where's your risk? That's the thing you have to determine here. There is no clean setup on gold right now where you could say, this is where my risk is going to be, unless you're going to say, all right, I'm just going to buy it just to have it in an account, which that becomes a whole different animal. NEE, I think, is coming down a little. Yeah, everything's starting to move down going into the FOMC. The FVRR 5-minute orb was nasty. Oh, did they have earnings? Hold on, did they? Oh, yep. Yep. So that was a good earnings one there. Oh yeah, you break here at like 24.14. Oh yeah, that's a great one, Tor. Yeah, we did. I tried AMD this morning. That one ended up getting stopped. But I mean, and then PayPal yesterday too. But I mean, that was a baby loss. You guys, I think, hit PayPal though, because some of you guys just kept it. But last week, I mean, on 3M 500%. The day before that, IBM 250%. Those were nasty. You think the S&P is going to top at 6,500 at the end of the year? That's really far away, isn't it? That's another 1,000 points. I mean, yeah, I don't know about that. That's very aggressive. AMD not having a great day. No, that one sold off. DRN is still looking good over here. We'll see what happens with that. Yields are going to be. I don't want that. I want US 10Y. I need the yields. Yeah, yields have been trending down for a while. So TLT, TMF. The other thing that I want everybody to pay attention to is we need to. Okay, so this is what everybody needs to be focusing in on right now. A lot of you guys think that you can just come into the market and say, "Oh, I'm going to put my little cookie cutter setup under the charts." Or some stupid thing that you're like overlaying and doing and think that that's going to make you money over the long term. Newsflash, it's not. What you have to understand is the actual story of what's happening in the overall macro environment. Post earnings strategy is awesome. Thanks for teaching us. No problem, Tor. That video, what did I post that 2 days ago for you guys? Yeah, that's a really good one. So the thing, you have to understand the big picture. If you don't understand the big picture, you're always going to struggle. That's what I'm here for. So what are we seeing right now? Well, we are seeing a little bit of the repatriation trade happening, because if you think about why the market is sold off, I mean, you could say, all right, it was kind of a domino effect of like all the concentration that was in Mag 7. So as those started to slip a little, everything else started to go as well. You saw the sector rotation kind of going into small caps. IWM still looks decent. I believe the Dow still looks all right as well. It's hanging above the 10. I think they're both hanging above the 10 EMA. IWM should still be looking very good. Yeah, IWM still looks nasty. So there's going to be some setups within IWM that are going to be really good. But what we're looking at now is like the actual niche sectors and what's doing well. So what's doing well right now? Utilities, financials, real estate. It's not big tech. So the other thing we have to realize as well is that if the overall S&P, I don't know why. I do have SPX on here. If we were to look at ES on the daily, I mean, it is starting to get back above the 10. You could view this as a trend shift if during Powell today we kind of close above, chop around, we don't do anything that crazy. But either way, it's going to need a little bit more time. The one thing that we talked about yesterday on the streams that, again, that you guys all got to pay attention to these things. What we need to start seeing out of the market is closes at highs. You can't see this and expect the market to come back up. Comes up, sells off, comes up, sells off, comes up, sells off. Closing at the low, closing at the high, but below the 10. Comes up, sells off. No closing at the highs. Now, today, we have the opportunity to see one of that. If that happens, I mean, that would be decent, and that would be a good start at saying, all right, we might balance out at some of these levels before the market really decides what it needs to see next. But other than that, I mean, we're just going to wait here and identify the best trades in the market as we always do. It's not that hard. Let's see. What were we looking? NEE, how's that doing? NEE 75.94. That's good. That entry this morning is looking really, really good so far. And again, team, we got some slackers on the like button. We got some slackers. It's Powell Day, team. Let's have a good day, huh? And remember, I'm live every day, team, for this month. What is it? Well, not July, August, basically. We're going to be live every day in August as we get closer to the rollout of the new Discord. That's going to be fun. So again, all you guys that are in those educational programs right now, you guys are getting access to it for free. Today's also the last day for the 40% off sale to all of those as well, which is also going to give you the what do you call it? Everything for free once it comes out in August. Crazy bounce on Dell. I mean, is this going to be like, is there anything going to be? No, there's nothing on here. Record highs on what? Incoming? I would put those. Okay, the odds of that happening are not zero. All right, it's not zero. I'll tell you what the odds of it are. Ready? Ready? I'll tell you what the odds of it are. Actually, I could actually tell you what the odds of it are. The probability of that happening, it's less. I would say it's less than 1%. Like in real terms, market moving 3% from where it already is. But I'll tell you what the options market says about it by using the delta. What is this? 5670. Let's do by today. So 5670 on SPX by the end of the day. What is the probability that the delta is telling us about that? Because it's probably zero. Well, hold on. That's 6,000. 5670. Let's see. Oh, hold on. Okay, the delta is 0.0005. So less than 1%, way less than 1%. Is there anything Powell can even say to be bullish? Yeah, there's a lot of things that he can say. There's a lot of things that he could say. I mean, he could talk about rate cuts. He could do all sorts of things. So you're saying there's a chance. Well, I'm saying it's a non-zero probability, but it's incredibly close to zero. And the thing is, and the thing is that even if that were to happen, let's just talk about it in a slightly different way. Even if that were to happen, you would make a lot more money by not, but you'd be buying like closer strikes. It wouldn't make any sense to do anything like that because the market could run 100 points and those contracts are not going to move. So I don't know why that's the thing that we're talking about here, but it's fun. All right. If we really want to have some fun, we can throw this on the 5-minute. For what? We got 18 minutes to go until we get the. This market's coming down. We're selling here. NEE doesn't really care. DRN came down a little bit, but doesn't really matter. Let's see here. And again, team, as you guys are filtering in, make sure you guys are hitting that like button, share the stream, let everybody know that we're live. It's gonna be fun. We're gonna have a fun afternoon. Oh, also, make sure you guys are following the new Twitter account too. Because I tried to let everybody know that I was going to deactivate the old Twitter account. So if you guys aren't following me on Twitter yet, Short the VIX 2, that's where I'm giving you guys some freebies, stocks that are about to explode before they do, post earnings trades, things like that. So make sure you guys are following that account, having those notifications on, because that's where I'm active. The other account doesn't exist. Aren't rate cuts bearish initially? Okay, people are trying to make arguments all over the place that like this is what the rate cuts are going to do. You can try and think about it in that type of way. The problem is that we're in such a different environment than we've ever been in the past that historically when you cut rates, you're cutting them because there's economic slowdown. So by cutting rates and announcing that's going to happen, that's almost like Fed capitulation. And they're basically saying, oh yeah, everything's actually bad. So it's a flashing sign that things are bad. Now, in this case, I don't actually know if that's going to happen because there's so much excess capital in the system that needs to go into the market. Now, this is another thing that I want to talk about with you guys that I was thinking about last night. No. It should be Short the VIX 2. It should just be Short the VIX 2. Let me see. Yeah, the Twitter account is Short the VIX 2. So this is the other thing that I think is kind of strange. Are we still going to get the notifications via email for the watch list? Yeah. Well, I mean, once the Discord is released, then it's just going to be in there. But until then, yeah. NEE looks really good. I love that. I love that one. This is the other thing. So if there's all this excess capital in the system, what you're going to see a lot of on Twitter is people are going to use, all right, let's just do the cleanest example, money market funds, to say, oh, this is the amount of cash on the sidelines. Money market funds don't actually show you that. They just show you cash sitting in the market money accounts. You don't know if that's like, oh, on the sidelines. And here's also why that doesn't make any sense. Let's say that every single cent, it doesn't have to be in money market funds, but every single cent of that money went into the market. They have to buy it from somebody. So you have person A, let's just say, and person B. Person A is not invested. Person B is invested. Person A buys, let's say, $100 of stock from person B, and person B sells them that stock. Person A no longer has cash on the sidelines. Person B now does. So it's not like cash on the sidelines. I just don't think is a real like metric. It's fake. It doesn't exist because when you sell something, your cash then goes on the sidelines. It would happen a lot quicker than that. You're not playing anything right now. I just have the NEE and the DRN. We're gonna see what happens with it. Bonds, USD, Dixie will tell the story after the first rate cut for downside concerns to really play out. I agree with you there. More, I would say the dollar is probably going to be more important than bonds because we know that yields are going to come down and bond prices are going to go up after cuts. What we don't know is by how much. So you don't know what percentage of the move that the bonds make is actually just based on yield, like rate cuts. You don't really know. For the dollar, you can easily say, all right, well, is there more or less demand for USD? Which right now, I mean, with the repatriation that we think has happened, I think NEE's at new highs here. Yeah, that's great. I love that. Love that. All right, we've got 14 minutes to go until the interest rate decision, which I don't think we're cutting today. Today, I don't think we're cutting. I think it's September. Who knows? I could be wrong. A lot of people are kind of expecting a cut. I don't think we're getting one, but we'll see. Where's Palantir? Those sold puts that I have on it. I think that has earnings on Tuesday. Yeah, that's fine. If they want to give me the shares, I'll take the shares. I'd be fine with that. Bond market seems to have already started front running the cuts. It's been doing that since the QRA, which was here. Right in here. Or it was this. It's one of these peaks. It actually might be this, where Janet comes in and starts buying. I think it's this. So it's right here is where they started front running, because if you guys were paying attention, I mean, we've talked a lot about it in the VIX Insights research reports, and on the streams, and I think we've done the video or two on it in the past, but that QRA announcement was a flashing signal to the market that they were going to start pushing bond prices up and yields down. And then Japan is the sneaky catalyst that nobody's really been aware of. The yen coming back up. Like everybody's like, oh, it's the economic data. No, it's not. It's the yen. The yen is one of the most important factors in the market right now that people are just failing to see. We were all over it though. Let's see. NEE looking pretty good over here. All right, you guys are nuts, man. 0 days. Have fun, man. Have fun losing money. All right, hold on. I gotta make sure I have the stream link queued up. I think I do somewhere. Where is it? Yeah, I got it. I got it. We just got the picture of the Federal Reserve and the. All right, we got the link up. Here we go. What do we got? 12 minutes? Let's have some fun, man. We're gonna have some fun on this. We are gonna have a lot of fun today, I think. I did kind of want puts for this, but I also don't, because I don't really need to hedge it. Everything that I have is it's just different. Oil's up 4.1%. Jesus. Where's Oxy? Exxon. Isn't there oil earnings on Friday? Talk about NEE a bit more. It's just a rotation into utilities. I mean, utilities were outpacing a lot of the other. Doesn't he speak at 12:30? Well, 2:30 Eastern, yeah. But 2 p.m. is when the interest rate decision comes out. So we have that. Then we have the Q&A at 2:30, which is going to be with the prepared remarks. It's going to be hilarious because they're going to ask him about election stuff. I think they are. Why do I think AMD sold off today? Market just didn't want to buy it. Because, well, I did say it in the pre-market. I was like, hey guys, the earnings weren't actually that good. So the fact that it was up, if they were going to do an irrational move to the upside, which they tried to do, it could easily just get sold off into. But the SoFi purchases we made are doing very well. What else? Philip Morris. Those have been really good. Let's see. And yeah, we're live. What do you call it? We're going to be live every single day until end of August. Any forex trades during FOMC? No, but it's entirely possible that me playing around with like the alerts and stuff on it is gonna set off currency alerts during Powell, which will be funny. SoFi will continue to soar. I think so too. I still gotta buy more of it. I only have, I think, like 6 grand of it. I need like 12, 15 rate decisions. No, I agree with you there. That's why I have it. I like Palantir a lot too. That's one of my favorite ones. I mean, I own that one. I definitely need more of, which is why I'm selling puts on it. I might just keep doing that and just keep selling puts. I got to do it in the big boy account though. I got to do it there. That account is still sitting at some great levels, even with some craziness. So I did sell 100 shares of AMD the day, well, right before their last earnings report, not today, or yeah, yesterday, but like last quarters. That was good. You're selling your Chipotle calls in? It's not time for Chipotle calls yet. I'll let you know. I mean, I'll tell you guys right now. Like, if there are stocks that are, remember, I was telling you guys about Tesla. I was like, guys, like, what was this in the first quarter? I was like, guys, Tesla's gonna give us a move at some point this year. You just have to be patient. NEE is ripping right now. There we go. You just have to be a little patient because it is going to happen at some point this year. And then what did we see? Right here. Everybody in Swing Kings nailed this one. This was perfect. Boom, blast off. I was going to give it out on the free Twitter. I just you guys needed to like the tweet when I was like, guys, I have 1,000% trade coming. You guys want it? And people were like, oh, yeah. It just didn't get enough likes on it for me to post it. So again, make sure you have notifications on for that new Twitter account. Because this is just dirty. Right now, there's not a whole lot of things that do look like this. NEE kind of does. I mean, it's ripping here. It is ripping. So what are my NEEs up? They're probably only up like 20%. Yeah, 20% on the NEEs. But these have time on them. I got more time on it just because it's a little wonky. I tried it because this was the move I was trying to ride this. I just couldn't get a good spot in here. Here looks perfect. This is very, very much very similar to how Tesla looked. So depending on what happens today with FOMC, I mean, this could be a big winner. Who knows though? Market running back up. Here we go, ladies and gentlemen. We got 8 minutes. 8 more minutes until Papa Powell comes out. And today's the last day to get 40% off all the education there. The hours of educational content. I mean, I've got some testimonials on the site there, but if you guys want to see some more what the results have been like with everybody, go on my Instagram and on my profile. I have a lot of those the testimonials of the messages that you guys send me. But I can tell you guys right now, I literally have never seen like you guys print this much. It's been ridiculous seeing all of your guys' growth. So shout out to you guys. You guys have been really killing it. Swing season has been good to everybody. Let's see. NEE looks good. DRN still looks good here, but we'll see what happens with that. $130 for you, yes. AI is going to be speed reading the statement, then 30 minutes later, he reads it out loud like we're school should. Yeah, like he's going to, yeah, it's the same. I don't know why he reads it the second time. We already know. He's like, for those of you guys that can't read, I will have story time with Jerome Powell. Market just ripping back up there. There we go. Let's see. My NEs are up 23%. That's good. Roblox looks good. Dude, Roblox looks really good, Cole. Like, so good. It has earnings tomorrow. If Roblox breaks up on earnings, we could get a nice little 5-minute opening range break on that one. We had that one earnings season where we went like 4 for 5 on them, and they were all like between 200 and like 800%. The two big winners from this earnings season have been 3M 500%. Those were epic. I handed that one out to you guys on the public stream on Friday, and then IBM the day before, but that was a private stream. So, I mean, don't miss them. DRN moving back up. Tessie. Here's another one. Mat's actually moved. I don't know where it is now, but yeah, I was going to take it as it broke that opening range because it never invalidated below here, but it was a little extended. It was moving a little slow. As soon as the Q&A starts, that's when the fireworks start. Oh, yeah. SMCI? No, probably not. Unless it really looks good, which it actually looks god-awful. I wish I could invert this chart, because if I could, I'd probably want to short it or go long the inverse. Any other big ones that have earnings tomorrow? I think Facebook. I think Apple has some earnings coming out. Let's see. Today's Facebook, ARM, Qualcomm, Carvana, Riot. Oh, today's big. Tomorrow could be fun. Facebook could be a really fun one. Tomorrow. Yeah, I mean, Amazon, Apple, Intel, Coinbase, DraftKings, Roku, Square, Mara, Booking. That's huge. That's a big day. Tomorrow's the big day. After hours for earnings. And then Friday morning, NFP. Is it too late to buy NEE? Well, I mean, yeah, kind of. I mean, my break was like here. I was looking at it 70. It was like right around 75 where I was getting it. So, yeah, it looks like you missed this one. We've been talking a lot about the utilities move on streams. Like we were looking at UTSL, XLU. When the Q&A ends, second round of fireworks starts. Yeah, I mean, I'm probably not going to do much with it, but where's AMD right now? Did it go red? It's only up 2%. That's icky. That's icky. If NEE can get up here to like 76, 71 today, that would be awesome. I would love that. Disney plans a new round of job cuts. Economists anticipate the Federal Reserve will unanimously decide to maintain interest rates. Yeah, I mean, that makes sense. 4 minutes to go, ladies and gentlemen. Again, as everybody's filtering in, make sure you guys are hitting that like button on the way in. I mean, it's also perfect timing this year, or this week too, for the post-earning strategy. I did post that video this week too. So if you guys missed that one, I mean, first, make sure you have notifications on for the channel so you're not missing anything. But two, I mean, that's going to be perfect for you guys. Made 58% on Tesla. There you go. There you go. All right, 3 minutes here. Uh-oh. We do have some slackers on the like button. We do. Uh-oh. Uh-oh. Slackers on Powell Day. I see how it is. DRN looks good. NEE looks good. I mean, even if it closed here, 76.20, that'd be a great start for it. Like, great start. With Powell, though, this could go literally anywhere. So, careful. Don't do anything dumb, guys. Do not do anything dumb. This is not the day to be a hero. Do you guys realize how many amazing setups we have forming for us? You're going to want to have the most amount of capital that you could possibly have to be able to take advantage of them. Like, you're not going to want to miss these trades, man. You guys have seen them. Like, they're just dirty. All the games that you guys see on the Twitter, the Instagram, all those multi-100 percenters and sometimes 1,000 percenters, like, you're going to want to make sure that you have some firepower for these. Oh, this is interesting. This is actually probably what's going to happen. Emily Rowland from John Hancock Investment Management suggested Powell is non-committal. Bond yields might rise, risk assets could sell off, and the dollar might appreciate. That is a real possibility. That is a real possibility. Yeah, AMD got whacked. Because he's going to say, like, he's not going to commit to September. Unless he pulls an ECB, which I think that's what the market's looking for. I just don't think he's going to do that. Like, the ECB just telegraphed their move, and they said, we have 2 minutes or less, or we have about a minute left here. The ECB telegraphed it and said, in Canada, I think. And they were like, well, we're going to do it here. And then they did. I don't think the Fed is going to do that. I think they're going to say it looks likely, but we don't know, which is non-committal, and yields could rise and everything could get whacked, and, you know, which honestly could be good for utilities. It could be. Because the risk that they have right now is not cutting too early. It's cutting too late. All right, team, 30 seconds to go. Here we go. Here we go. 30 seconds until we're on the 5-minute time frame here. This is hilarious. The freaking 5-minute, dude. This is gonna be, it might be a dud. I don't know though. 10 seconds. 10 seconds. 10 seconds. Here we go. 5, 4, 3, 2, 1. Uh, oh, uh, uh. What do we got? No, call. I'm not doing anything on it. All right, here we go. Yeah, unchanged, obviously. So no cut, no cut. I just think it's going to be a dud. Yeah, rates unchanged. I mean, that was kind of what I was saying. Like, I don't really think it's going to do a whole lot. If anything, it's just going to flatline or it's going to tank. Wow. FOMC reiterates. Yeah, that's non-committal. No rate cuts until it is more confident that inflation is moving to 2%. What are yields doing? Yields up. Uh-oh. Uh-oh. Inflation has eased but remains somewhat elevated. Oh, they're going to try and push us into a recession. We're kind of already there. I don't think the market at this point is probably just going to look at this and say, yeah, you're probably cutting in September. Confidence in inflation to 2. What does that say? Plan intact. Yeah. Nothing changed. Q&A will be fun. I think they're going to ask him about politics. Rates coming down in September. No, that's what the market thinks. That's not what the Fed is saying, which is a big difference. Nothing's moving here. This is a dud here. We were here data dependent. Yeah, they're just going to be like, we're going to remain data dependent. We're going to look at the incoming data as it comes. We need more confidence that we're heading back to 2%. Here's the deal, guys. They're never going to get to 2%. They're not getting there. Just letting you know now. It's not happening. I do not think that we're getting inflation to 2% unless, here's the caveat here, unless they screw with the numbers. If they screw with the numbers, they can get it to wherever the heck they want. But on the actual data, like real data, if the data were to come out as true, they're never getting it back to 2%. 3% is the new 2%. And everybody's going to have to be all right with those increases. It's just, I mean, how are they going to get it down? They're going to have to leave rates higher, and then they're going to basically bankrupt the Treasury, which we've talked about time and time and time again. They can't do it without bankrupting the Treasury, which they will never do. Fed emphasizing inflation has continued to show progress before cuts. Yeah, well, if you're showing progress at every single meeting, that's the thing. It's like, it's talking points. It's the same thing that you see on the media, everything. It's just talking points. Oh, we're showing progress. It's like, okay, if we've shown progress at every single meeting over the last 6 months, then why do you need more confidence? If your confidence level is high, you're seeing the proof every single meeting or every single like report that like, yes, it is coming down to those levels. Here's what we do have to think about though. This is the one thing that is important to what we're seeing. If you look at and he did make this point, which it's kind of valid but kind of not after the data, which is the next rounds of data that we saw. Some of the inflation data from a year ago was really low. The month over month increases were really low, like zero low. Now, if the data that comes out now is higher than that, well, obviously the year over year numbers are going to tick up because those old data points are getting taken out of the equation and the new data points are getting added. That is the one thing that you have to be aware of. But is it that big of an issue? I mean, not really. So, all right, let's see what else we got here. U.S. short-term interest rate futures slip after FOMC decision as traders slightly pair bets on Fed rate cuts. Let's see. Fed repeats need for greater confidence on inflation to cut rates. Notes unemployment rate has moved up but remains low. Hold on, we gotta go back here. FOMC attentive to the risks to both sides of the dual mandate. So we'll see. I mean, NEE is still looking at a good spot. When they quit using data to cover a 2-year period, move to a 1-year period, that's a game changer. Correct. And it does. I mean, it creates It does a couple of things. I mean, it does mess around with like it does make it a little lower, which is the reason why they did that was the cost of living adjustments for Social Security, so they had to pay everybody less. That is one of the things that they did. Oh, you guys are crushing the like button. Keep it up, team. Here we go. We got what, 25 minutes to go until the Q&A. That's going to be fun. And remember, guys, today's the last day to get this is I honestly shouldn't be giving you guys this deal, but I am because I'm nice. It's 40% off to all the educational videos, the hours of them. Like the day trading mastery courses, like that strategy's had like 19 winning months in a row for a very good reason. The Swing Kings course, the watch list of stocks that are about to explode before they do, and you're gonna get access to the Discord for free when it launches, like at the end of August into September. Meaning you're not gonna have to pay for it monthly. Everybody else is. So the 40% off deal ends today. The deal will be 20% off in August, but I mean, you're still going to get access to the Discord for free, but you're going to have to pay more. So, I mean, I can throw the link in the live chat here for you guys. The code is STV40. You guys know the deal at this point. Like it's the best trading education you guys are ever going to get. You guys see the results every single week. If you guys want to actually take your trading seriously and get the strategies that are going to enable you to have long-term success, there you go. Let's see here. Market turning up, but not doing a whole lot. Not doing a whole lot. Objects in the rear view mirror. Yeah. DRN's turning up a little. NEE still looks really good. AMD turned up a little there, but nothing crazy. Oh, this is probably funny. That's actually really funny. It's like a meme. It's like a Powell, and he's like, I'm playing both sides so that I always come out on top. It's like, it's kind of true. We still getting VIX insights? Yeah, that's also going to be included. There just hasn't. I'm going to do one for you guys after like this Fed meeting and Powell. But again, the last VIX insights research report, what was it about? Japan. How Japan was the reason, the secret catalyst that nobody was talking about. That what do you call it, was gonna give everybody like the sell-off that everybody wanted. Everybody's like, no, it's data, no, it's this, it's no, it was Japan. So like until that played out, there really wasn't else to look at. I could have written one up about SoFi, but I kind of gave you guys on that one. Have I used Bookmap? No, never used Bookmap. I can see why it's useful with the concentration of orders, like where they are. It kind of gives you a different look on the order book, which is kind of cool. It's just not like most of what I mean, the day trading strategies that I use, you literally don't have to know anything. Like you can just turn your brain off and be like, this is where the retracement level is. This is where you buy. Like we have Cole in here. He's like 18 years old, found me on Instagram and is just crushing it with everything. Same thing with Trey. Trey's passing and getting payouts from prop firms with it. And most of what I do is swinging anyway, just finding stocks that are about to explode before they do. So, which is going to be a lot more beneficial for people, especially new people coming into the market. Like it's way easier to learn and execute swing trading than it is day trading. The margin for error for day trading for new people is so low. You're paying monthly. Is that changing? Yeah, I'll cancel all of you guys on VIX Insights once we release the Discord, because it'll be included in the Discord. But yeah, I mean, I think Bookmap's cool. It's got like the circles and stuff. I've never used it, but I've seen it used. Balancing inflation and employment's a huge challenge. Like it, yeah. All right, NEE looks good. DRN still looking good. Where's SoFi here? SoFi still. I mean, our buys down in here were perfect. You guys front ran me on the SoFis. You guys were getting it at 630. I got it at 650. Can see behind the candles. Yeah, I mean, it's cool, but you never know because it changes. Actually, what you'd probably like better is something that I have that nobody else does. The peak positive and peak negative is better than Bookmap because, like, think about it like this. Bookmap is going to incorporate like all the retail orders, institutional orders, and traders. But what you don't see on Bookmap is basically using like Gamma and Vanna and Charm and the different Greeks to see where the market makers are at the most risk, because they're the ones that are going to push everything around anyway. So if you can see that, it actually, because I've looked at the differences, it's better than Bookmap in that regard, which I've used it a few times for some like dirty trades. Do you sign up for something else too? No, Christopher. So no need to be confused, everybody. So we'll go through it again. Everybody that is in all of the educational programs. Also, those of you guys that take advantage of the 40% off sale that ends today, you guys are going to get the Discord for free. The way that you get it for free is I email it to you once it's ready to go. Those of you guys that are in VIX Insights, I'm just going to cancel it once that's time, and that's going to be included in the Discord. You guys are going to get a code that's going to be free once it releases. Okay? Does everybody understand that? I was getting messages like, where can I sign up for it? And I'm like, it's not out yet. When I say, I don't think people know what like month it is sometimes. They're like, not you, Christopher. But people are like, where can I sign up for it? I'm like, does launching at the end of August mean anything to you? I don't know. But yeah, peak positive, like Ralph, you've seen it. The peak positive and peak negative stuff is filthy. That is a better illustration of what's going on in the market than what do you call it? Than Bookmap is. NEE looks good. You're tracking now? Yeah, I was gonna say, like, this rate cut? No, there is no rate cut. No rate cut yet. September, probably. They might wait until after the election. It's possible. It is possible that they do that. I think it would be, all right, here's what's going to be really funny, is if Powell gets political questions during this Q&A. He's going to lose his mind. Almost as much as I lose my mind when people are like, take a trade on the stream. I'm like, dude, why? I'm like, I'll let you know once the stocks are about to explode. Until then, quiet. NEE looks good. DRN looks good. SoFi, we're up nice on those. I still need to buy more. If you look at it on the weekly, it got a nice little retest yesterday at the 10. Could have bought there. I do need more of this. Pretty dumb statements that I read through it. Market not reacting after the earnings recovery. Yeah, I mean, it isn't bad. The one thing, though, that you got to look at is this. How yields reacted. Because he was a little bit non-committal, but it could just be like I don't know why he wouldn't just come out and telegraph the move, because like Powell is talking all the time. Like if we're gonna allow the Fed to give guidance the way that they do, which they shouldn't, they should just come out at the meetings and say, this is what's happening. Not, oh, we're gonna have Powell be on the cover of Time magazine or whatever the heck because he's some sort of celebrity. That doesn't make any sense. But like if they actually think, like they need to stop with the talking points is what I'd say. Like you can't, because think about it like this. What did we have? The talking points in almost any regard are just going to lead to trouble. Think about the old talking points from the Fed. Inflation is transitory. What was the other one? There were more. Inflation is transitory was one of the biggest ones. That was just a complete lie. What kind of wasn't? They should have said increases in inflation are transitory, because that's what actually happened. Inflation is not transitory. You will never have zero inflation, because that's what that implies. If you say inflation's transitory, they're effectively implying that inflation is going to go away, which it never will. So they should have said inflation increases are transitory, but they're not. Like, they wouldn't come out and say that. All right. The what? Matthew, I haven't been over there in like a year. I've got no idea what's going on, bro. And I also don't care about drama. Like, I really don't care. You have 500 shares of SoFi. You're looking at 11 or $10. Let's see. On a hold, you're gonna stop adding after next month. Just think it's better to put it somewhere else if you do love so far. Yeah, it's fine. Do what you gotta do. I like it. I own it sub 7. NEE starting to move up a little. I like it. I like it. Utilities have been hot. XLU. Oh wait, I don't want it on here, but XL. Let's pull up XLU. XLU's been looking really good. See. Transitory means it can go away and come back. No, it basically means it's temporary. That's basically what they're saying. What's UAW? What's UAW? Detroit? Is it a union? Is that a union? What is that? I don't know what that is. Is that like a complete brain dead thing for me to not know what that is? How does Nike look? I'd say bad, but I haven't looked at it in a while. Honestly, I mean, if that flatlines, I'd be really interested in it. Like, really interested. All right, can we stop having all these political press conferences? Right, like during Powell. Your strategy is so easy to use. I know, Mo. It's awesome, man. It is awesome. Again, I mean, I'm giving you guys the biggest United Auto Workers. Oh, that's interesting. Call their state, dude. I got no idea, bro. Like, I've got no idea, man. Yeah, it is easy, Mo. Again, you're not gonna get 500 to 1,000% gains all the time anywhere else. It ain't happening. Here comes NEE moving. This one is not gonna be like a. Well, I mean, it could. Like if it were to rip to 80, like right now, but I don't think that's gonna happen. So we'll see. NEE new highs. That's what we like. What are those up right now? We got what? 13 minutes to go until the press conference. 22% on the NEEs. Those are looking good. All right. Let's see what we got. Oh. If I had an opinion, I just don't care, man. Like, it doesn't have anything to do with me. Let's see. He's going a little here. That thing's going a little. This could be fun. This could be fun, man. That could be a good one. Yeah, make sure you guys are all following that new Twitter account too and have notifications on. I mean, I've been throwing out some gems on there for you guys. Short the VIX 2 is the at on that one. Anybody know if Apex will let you trade this? I don't know. I don't know. But I think there's like 1 day left for the 80% off sale. So if you guys are interested in that, I mean, there's the link for it. I think that's the Apex link. So if you guys need more Apex accounts, there you guys go. I mean, it's 80% off in 1 day to pass. That's pretty nuts. You wish you would have bought some NEE? I mean, that was my like favorite setup kinda for today. David's gonna be testing his diamond hands today on success. Yeah. I just can't. I don't want it. It's just a hedge for everybody. The volume spikes is just them hedging. It's because they don't want to sell the Nvidia. Because like I hear stories all the time where it's like, oh, I'm at a dinner party and I feel bad that I don't own Nvidia and everybody else does. And like you got to think about it. The money managers are gonna the YouTube channel. Oh, there's no other YouTube channel. Oh, the VIX Insights one. I haven't posted on that one yet. The Twitter account is short the VIX too. Because the other Twitter account doesn't exist anymore. So if you guys want to follow me on Twitter, it's short to VIX too. All right. NEE looking great. I want to see that thing push. Boeing, I had some alerts fired off on it today, but I think they were old alerts. I don't know. Boeing looked pretty good. It's just kind of, oh, it was earnings. That's why. Yeah, I wouldn't have done anything with that. All right, 10 minutes to go, ladies and gentlemen. I hope you guys are ready. And remember, I mean, I'm going to be live every day until the end of August. And then we'll go back to the Monday and Friday schedule publicly. So then the private live streams will start back up with you guys in September. All right. Where's Palantir right now? How's that looking? Chilling. Just keep bleeding out those put premiums. Good. Bleed them out. Make me money. I actually kind of do want to buy the shares at 25. But I don't know if it would have to be on a giant earnings gap down. Like, remember what I was saying? I was like, if it can be here for earnings, I'd be fine with that. If it's like down here on earnings, I'd be a little worried. Fed live. In about 9 minutes, we're gonna get Papa Powell. About 9 minutes, we're gonna be getting Jerome. Why do you have so many question marks? It's almost like you think he's like, it's like the second coming of Jesus Christ. Like, yeah, Powell. I don't know if you knew this, man. I'm not trying to be mean, but like he does go. He does. Well, he doesn't go live. Like Powell doesn't just like spin up OBS and is like, all right, guys, we're gonna play some Fortnite, and I'm gonna talk about macro. But his press conferences are live streamed every single Fed meeting. He's not gonna just like queue up Fortnite and be like, "Hey," like get all the streamers involved. But I mean, he does. His press conferences are live. All right, NE's looking good here. I mean, I should probably just throw like what it looks like on here. I think I got it like right here. Stops below here. Target in and up here. Well, I mean, this is a good target, or this one right here. First TP 78.21. I don't know. I want to see these contracts go up 100%, make them free. Do our normal nonsense, 10 minutes until Powell reads us all a story from his storybook. Takes about 5 to 7 minutes, and Q&A begins for about 45 minutes. Yeah, but don't we have like if he goes longer, it's usually not great. Powell playing Fortnite live would be epic. Do you know how funny that would be? If Powell was just like, you know what, man, we're gonna go live on Twitch for this time. Or if it was like a Twitter Spaces with like Mario hosting. And like, you know how funny that would be if they just had like all those people on like a Twitter space, and then the Q&A is from like FinTwit. That would be honestly the best FOMC meeting in history. They should do that. The problem is like people would then talk over Powell. So the moderators of that would then have to like they'd have to ask their question, and then they'd have to like manually mute the other person, so that or everybody else, so that nobody would talk over Powell. Because that's not the point. It's like not a debate, but it'd be cool to get questions from everybody. Oh my god, my news feed is hilarious right now. NEE new highs looking really great on this utilities trade so far. Again, I try and let you guys know and explain this to you guys. If you don't get it by now, you will after years of losing. You have to understand the big picture in order to have long-term success in the market. You absolutely cannot try to put some cookie cutter nonsense thing onto the chart and expect to have success. It's not going to happen. It just isn't. And you also have to make sure you're trading in a way that's going to give you the ability to capitalize on very, very, very big moves. Like this, like Tesla, like all the other gems. I am very excited for a firm in Q4. That's going to be a fun one. UNH on the daily. I've taken a look at it. It's been the post earnings move was disgusting. This one, I actually really do like UNH here. Reaper, good call. And I mean, that's a great example of kind of how the Discord's going to be. Like everybody knows exactly what to look for, which is perfect. So it's just going to be a hive mind of just money printing, finding stocks that are about to explode before they do, and just stealing from the market. It's going to be great. NEE looking good. DRN looking good. What are yields doing? I think they dropped back down a little bit. A little bit. ES at this level pre-Powell is getting you excited. I still think it's going to be a dud. Now that we've seen this, I still kind of think this FOMC meeting is going to be a dud. And then everything's going to move on NFP because he's going to guide for jobs numbers. And then we're going to see it reflected in NFP. And we also have the biggest earnings day, I think. I'd have to look. But it looks like tomorrow after hours is the biggest earnings day of this earnings season. So the end of this week is going to be really fun. I do really like UNH here, though. Oh, yeah. Oh, yeah. Oh, yeah, UNH. That would be a really fun one if that were to get going. That'll be good. And then the post-earnings moves. I mean, if you guys haven't watched that video yet, I mean, that's how I just lay it out for you on a silver platter. Here's how you can make 500% on earnings. Not holding through the event. Easy. XLV is obviously a tight setup. UNH, not one of the largest. Yeah, it is. XLV's been doing well too. If you look at those the SPDR sector ETFs, NE is the UNH of that ETF. Yeah, because NEE I think is the biggest part of XLU. I think. I'm like pretty sure. What do we got? 3 minutes until we get Powell. Here we go. I hope you guys are ready. We haven't seen Powell in a month. We've had so many crazy things happen in the last month too. Dude, the news feed is hilarious right now. Yeah, I mean, I can grab the link to the my new Twitter account too. Meaning the old Twitter account doesn't exist anymore. So those of you guys that think you follow me on Twitter, you know, this is the new one right here. Boom. There you go. NEE screwing around. Your boring report is becoming the swing traders option targets for upside. Kind of funny. Yeah, it is. Yeah, well, IWM still looks really good. I'm still trying to find ticker. All right, this is not homework, but this should be everybody's focus. We need to find tickers in IWM is what we need to do. There's 2,000 tickers. We need to find some good ones in there because IWM looks really good. Think about why though. Like if you're going to see small caps go, why? At this time of year, at this time in the cycle, why would small caps go? Well, rates are probably going to start coming down at some point. That's why people have been rotating into small caps. It's not just, oh, look, the large caps have done very well. Let's go take a lot of that money and then go super risk on. No. Why did I dump the old Twitter? Because it was just a bunch of nonsense. Like people on there just like weren't like, I didn't like that Twitter account. I just didn't like it. Like there were a bunch of people on there that were like it's not only that they just like didn't want it, they were actively trying to not make money in the market. And I was like, I don't need these people. Build a new Twitter account, have some more fun. Weekend homework. The IWM, yeah. So they do have the most earnings. That is the other thing I was seeing as well. They do have the most earnings. But yeah, that's the new Twitter account. And then the Instagram and TikTok are cruising as usual, ladies and gentlemen. But yeah, that's the new Twitter account. Make sure you guys are following that one. All right, as soon as Powell starts talking, I'm probably going to grab water, turn the AC on. I'll be able to hear him, though. We have less than a minute. 37 seconds to go. Here we go. And then, yeah, team, remember, I'll throw this link in here as well. Today's the last day for the 40% off sale, too. So the code is STV40 here. You get access to both the educational curriculums, the watch list of stocks that are about to explode before they do, direct access to me to answer any of your questions. And most importantly, you guys are going to get free access to the community when it launches. And the fee for everybody else that's going to pay monthly is going to be a lot more. FTAI. It's not perfect though, right? We need to look for it to be perfect, you know? That's what I want to see. I need perfect. Oh, hold on. Powell might be on. Oh, I don't see him yet, but he's close. He's close. Oh, he's opening the door. Here we go.
Good afternoon. My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. Our economy has made considerable progress toward both goals over the past 2 years. The labor market has come into better balance, and the unemployment rate remains low. Inflation has eased substantially from a peak of 7% to 2.5%. We are strongly committed to returning inflation to our 2% goal in support of a strong economy that benefits everyone. Today, the FOMC decided to leave our policy interest rate unchanged and to continue to reduce our securities holdings. We are maintaining our restrictive stance of monetary policy in order to keep demand in line with supply and reduce inflationary pressures. We are attentive to risks on both sides of our dual mandate, and I will have more to say about monetary policy after briefly reviewing economic developments. Recent indicators suggest that economic activity has continued to expand at a solid pace. GDP growth moderated to 2.1% in the first half of the year, down from 3.1% last year. Private domestic final purchases, or PDFP, which excludes inventory investment, government spending, and net exports, and usually sends a clearer signal of underlying demand, grew at a 2.6% pace over that same period, the first half. Growth of consumer spending has slowed from last year's robust pace, but remains solid. Investment in equipment and intangibles has picked up from its anemic pace last year. In the housing sector, investment stalled in the second quarter after a strong rise in the first. Improving supply conditions have supported resilient demand and the strong performance of the U.S. economy over the past year. In the labor market, supply and demand conditions have come into better balance. Payroll job gains averaged 177,000 jobs per month in the second quarter, a solid pace, but below that seen in the first quarter. The unemployment rate has moved up, but remains low at 4.1%. Strong job creation over the past couple of years has been accompanied by an increase in the supply of workers, reflecting increases in participation among individuals aged 25 to 54 years, and a strong pace of immigration. Nominal wage growth has eased over the past year, and the jobs to workers gap has narrowed. Overall, a broad set of indicators suggest that conditions in the labor market have returned to about where they stood on the eve of the pandemic, strong but not overheated. Inflation has eased notably over the past 2 years, but remains somewhat above our longer run goal of 2%. Total PCE prices rose 2.5% over the 12 months ending in June. Excluding the volatile food and energy categories, core PCE prices rose 2.6%. Longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households and businesses and forecasters, as well as measures from financial markets. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. In support of these goals, the committee decided at today's meeting to maintain the target range for the federal funds rate at 5.25% to 5.5%, and to continue reducing our securities holdings. As the labor market has cooled and inflation has declined, the risks to achieving our employment and inflation goals continue to move into better balance. Indeed, we're attentive to the risks to both sides of our dual mandate. We've stated that we do not expect it will be appropriate to reduce the target range for the federal funds rate until we have gained greater confidence that inflation is moving sustainably toward 2%. The second quarter's inflation readings have added to our confidence, and more good data would further strengthen that confidence. We will continue to make our decisions meeting by meeting. We know that reducing policy restraint too soon or too much could result in a reversal of the progress we have seen on inflation. At the same time, reducing policy restraint too late or too little could unduly weaken economic activity and employment. In considering any adjustments to the target range for the federal funds rate, the committee will carefully assess incoming data, the evolving outlook, and the balance of risks. As the economy evolves, monetary policy will adjust in order to best promote our maximum employment and price stability goals. If the economy remains solid and inflation persists, we can maintain the current target range for the federal funds rate as long as appropriate. If the labor market were to weaken unexpectedly or inflation were to fall more quickly than anticipated, we are prepared to respond. Policy is well positioned to deal with the risks and uncertainties that we face in pursuing both sides of our dual mandate. The Fed has been assigned two goals for monetary policy: maximum employment and stable prices. We remain committed to bringing inflation back down to our 2% goal and to keeping longer-term inflation expectations well anchored. Restoring price stability is essential to achieving maximum employment and stable prices over the longer run. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to your questions.
Here we go.
Gina Smilik from the New York Times. Thanks for taking our questions. Markets pretty much entirely expect a rate cut in September at this stage. I wonder if you think that's a reasonable expectation, and if so, why not just make the move today?
Thank you. So
On
September, let me say this. We have made no decisions about future meetings, and that includes the September meeting. The broad sense of the committee is that the economy is moving closer to the point at which it will be appropriate to reduce our policy rate. In that, we will be data dependent, but not data point dependent. So it will not be a question of responding specifically to one or two data releases. The question will be whether the totality of the data, the evolving outlook, and the balance of risks are consistent with rising confidence on inflation and maintaining a solid labor market. If that test is met, a reduction in our policy rate could be on the table as soon as the next meeting in September. So you asked why not today, and I would just say, again, that the broad sense of the committee is that we're getting closer to the point at which it will be appropriate to reduce our policy rate, but that we're not quite at that point yet.
So just to follow up on that a bit, if inflation behaves as you expect between now and September, would you regard a cut in September as sort of the baseline scenario right now?
So I guess I would think about it this way.
Ask about September.
I'll give an example of cases in which it would be appropriate to cut, and maybe that it wouldn't be appropriate to cut. So
I like this.
if we were to see, for example, inflation moving down quickly or more or less in line with expectations, growth remains, let's say, reasonably strong, and the labor market remains, consistent with its current condition, then I would think that a rate cut could be on the table at the September meeting. If inflation were to prove, stickier, and we were to see higher readings from inflation, disappointing readings, we would weigh that along with the other things. I think it's going to be not just any one thing. It's going to be the inflation data. It's going to be the employment data. It's going to be the balance of risks as we see it. It's going to be the totality of all of that help us make this decision.
And just to follow up on that, specifically, in what ways right now, given all you've seen over the last few months in particular on shelter, on services, et cetera, in what ways are you not confident right now that inflation is on the way back to 2%?
I think it's just a question of seeing more good data. We have seen the last couple of readings have certainly added to confidence, and we've seen progress across all three categories of core PCE inflation. That's goods, non-housing services, and housing services. So it's really just we had a quarter of poor inflation data at the beginning of the year. Then we saw some more good inflation data. We had 7 months at the end of last year. We just want to see more and gain confidence. And as I said, we did gain confidence, and more good data would cause us to gain more confidence.
Colby.
Thank you. Colby Smith with the Financial Times. The March SEP pointed to 3 cuts in 2024 with core inflation at 2.6% and the unemployment rate at 4%. Since we're now at that level in terms of inflation and already beyond what was projected for the labor market, I'm just wondering if that rate path is back to being the best guidepost for policy rather than, let's say, the shallower one laid out in the June SEP.
So I would just say, really the path ahead is going to depend on the way the economy evolves. And I can't really give you any better forward guidance on it than that. We didn't, of course, do an SEP at this meeting. We will do another one at the September meeting. I would just say I can imagine a scenario in which there would be everywhere from 0 cuts to several cuts, depending on the way the economy evolves. And I wouldn't want to lay out a baseline path for you there today. I've said what I can say about September and about today, though.
Hi.
Nick Timmeros of the Wall Street Journal. Chair Powell, you've said before that you wouldn't wait until inflation got to 2% to cut rates because of how inflation has lagged. Does that apply for the labor market too? If the labor market is back in equilibrium, why is restrictive policy and potentially very restrictive policy, given the high real funds rate, warranted right now?
So this is the very reason that we're thinking about that we've said in our statement that we're going back to looking at both mandates, and that we think the risks are coming back into balance. We think what the data broadly show in the labor market is an ongoing gradual normalization of labor market conditions. And that's what we want to see. We've seen that over a period of a couple of years, and a move really from overheated conditions to more normal conditions. We are watching the labor market conditions quite closely, and that's what we're seeing. If we start to see something that looks to be more than that, then we're well positioned to respond. That's part of what we're thinking.
And when you talk about seeing something that's more than whatever softness or slowdown you expect, in the past, you've said that stronger growth wouldn't override better news on inflation. I wonder how that cuts the other way. If you're seeing more softness in the labor market than what you would expect, does that change the calculus on what you're looking for out of the inflation numbers to recalibrate policy?
So we have growth isn't one of our 3. We have 2 mandates, as you know. The labor market, maximum employment is one, and stable prices is another. So we weigh those 2 things equally under the law. When we were far away from our inflation mandate, we had to focus on that. Now we're back to a closer to even focus. So we'll be looking at labor market conditions and asking whether we're getting what we're seeing. And as I said, we're prepared to respond if we see it that it's not what we wanted to see, which was a gradual normalization of conditions. If we see more than that, and it wouldn't be any one statistic, although of course the unemployment rate is generally thought to be a good single statistic, but we'd be looking at wages, we'd be looking at participation, we'd be looking at all the things, surveys, quits, hires, all of those things to determine the overall status of the labor market. But we're looking at it now. I would say again, I think you're back to conditions that are close to 2019 conditions, and that was not an inflationary economy. Broadly similar labor markets then. I think core inflation was actually running below 2%. So I don't now think of the labor market in its current state as a likely source of significant inflationary pressures. So I would not like to see material further cooling in the labor market, and that's part of what's behind our thinking. The other part, of course, is that we have made real progress on inflation, and we've got growing confidence there that we are not quite there yet, but we're getting more confident that we're on a sustainable path down to 2%. So those 2 things are working together, and we're factoring those both into our policy.
Chris.
Chris Rugaber at Associated Press. You mentioned not wanting to see any further cooling in the job market. Why not or would you consider preemptive cuts to prevent if you saw risks of an unexpected cooling? Is that something you would cut ahead of time for?
So I wouldn't say I wouldn't want to see any other cooling. It would be more of a material difference. If we'd be looking at this and if we see something that looks like a more significant downturn, that would be something that we would have the intention of responding to. So in terms of I don't think of it that way. I think of it as, we're actually in a good place here. We're balancing these two risks of, go too soon and you undermine progress on inflation, wait too long or don't go fast enough, and you put at risk the recovery. And so we have to balance those two things. That's the nature of having two mandates. And I think this is how we balance them. It's a rough balance, but it does feel like that. Again, the labor market feels like it's in a place where it's just a process of ongoing normalization. 4.1% unemployment is still historically low. And we'll just have to see what the data show us.
And just to follow quickly, wanted to see what you thought of the recent JOLTS report, which did show gross hiring has come down even below 2019 levels. Layoffs remain low. So it painted a picture of a very static labor market. Is that sustainable in your view or something that is worrying? Thank you.
So I think all of the data points continue to point to kind of the direction we would want to see. So that was taken as there was a decline in job openings. That was good. Today's ECI reading was a little softer than expected. So that's a good reading. It shows that wage increases are still at a strong level, but that level continues to come down to more sustainable levels over time. That's exactly the pattern that we want to be seeing. So I think the data we've been seeing in the labor market are broadly consistent with that normalization process. Again, we're closely monitoring to see whether it starts to show signs that it's more than that.
Steve.
Steve Leisman, CNBC. Mr. Chairman, back in March, you talked about cutting rates as a process, and in June, you talked about the idea that, one rate cut wouldn't do anything. So I wonder if you can sort of follow up on Colby's question. Talk about, are you weighing the economy right now in terms of its ability to withstand multiple rate cuts? Talk us through the process that you're thinking, or is it just one rate cut? Or are you in the process now thinking that rates need to be normalized here? Thank you.
Yeah, I can't really say that, honestly. We've seen, significant movement in the labor market. And, we're very mindful of this question of is it just normalization or is it more? We think it's just more normalization, but we want to be in a position to support the labor market. At the same time, we're seeing progress on inflation. So, we actually got to this, we raised rates a year ago at the July meeting. And if you look at the situation in the economy a year ago, inflation was over 4%. It was a completely different economy. Now we've made a lot of progress, and the labor market, I think unemployment was in the mid threes. So it's a different economy, and I think it's coming to be time to adjust that so that we support this continued process. The thing we're trying to do is, that we've had this really significant decline in inflation, and unemployment has remained low. And this is a really unusual and historically unusual and such a welcome outcome for the people we serve. What we're thinking about all the time is how do we keep this going? And this is part of that. We think we don't need to be 100% focused on inflation because of the progress we've made. 12-month headline at 2.5, core at 2.6. It's way down from where it was. The job is not done on inflation, but nonetheless, we can afford to begin to dial back the restriction in our policy rate. And I think we're just as part of a process. In terms of what that looks like, I think most you would think in a base case that policy rates would move down from here, but I don't want to try to give specific, forward guidance about when that might be, because with the pace at which it might happen, because I think that's really going to depend on the economy, and that's highly uncertain.
Rachel.
Hi, Chair Powell, Rachel Siegel from the Washington Post. Thanks for taking our questions. on inflation, do the past few months of good reports look like what we saw last year, where you really had a lot of momentum with a few bumps in between? Would you characterize that kind of momentum as back on track at this point in the year?
Actually, what we're seeing now is a little better than what we saw last year. Last year, as we pointed out late in the year, a whole lot of the progress we saw last year was from goods prices, which were going down at an unsustainable rate, disinflating at an unsustainable rate. This is a broader disinflation. This has goods prices coming down, but we're also now seeing progress in the other two big categories, non-housing services and housing services. So, so the thing is, you got 1/4 of that. We had 7 months of low inflation. You got 1/4 of this. I would say the quality of this is higher, and it's good, but so far it's only 1/4. So I think we need to see more to know that we're to have more confidence that we're on a good path down to 2%. But as I mentioned, our confidence is growing because we've been getting good data, and things like the ECI report, and frankly the softening in the labor market conditions, give you more confidence that the economy's not overheating. It doesn't look like an overheating economy, and it looks like an economy that's normalizing.
Okay. And if we were to think about the first couple of months of the year, is there any sense now that they were these blips that could have actually allowed for earlier rate cuts, as were some of the projections going into 2024?
So the thing about if what it is seasonality, and it could just be, it's very, very hard to do appropriate seasonal adjustments. If that's what it is, then that actually implies that other months were reporting too low inflation. If you smooth it out, it's a zero-sum game. And that's why we look at 12 months. We look at 12 months because that takes all that out, all those effects out. 12-month now is 2.5% headline, 2.6% core. This is so much better than where we were even a year ago. It's a lot better. Now, the job is not done. I want to stress that, and we're committed to getting job inflation sustainably down to 2%, but we need to take note of that progress, and we need to weigh the risks to the labor market and the risks to our inflation target now more equally than we did a year ago.
Michael McKee from Bloomberg Radio and Television. I'd like to ask you about the balance of risks as the American people see it. At this point, is the risk greater to leave interest rates where they are, given the damage that higher interest rates do to the economy in slowing demand and raising prices? Or is it more important for the American people that you keep rates where they are to bring inflation down?
I think that we've been given an assignment by Congress. This is how we serve the American people, is by achieving maximum employment and price stability, right? And so in our, quasi-constitutional document, the Statement on Longer Run Goals and Monetary Policy Strategy, we look at the two goals, and if one of them is farther away than the other, the two variables, inflation and employment, if one is farther away from its goal than the other, then you concentrate on the one that's farther away, and you take account of the time to reach the goal. So for the last couple of years, the best service we could do to the American people was to focus on inflation. But as inflation has come down, and I think the upside risks to inflation have decreased as the labor market has cooled off. Now labor market has softened, probably the inflation is probably a little farther from its target than is the employment, but I think the downside risks to the employment mandate are real now. So we have to weigh all that. And if you think about where that takes us, is we have a restrictive policy rate. It's clearly restrictive. It's been the rate we've had in place for a full year. And the time is coming, as other central banks around the world are facing the same question. The time is coming at which it will begin to be appropriate to dial back that level of restrictions so that we may address both mandates.
Well, you have event risk, basically, with the jobs report on Friday and another one before you meet again. Are you certain that you won't fall behind the curve and lead to unnecessary unemployment?
That's a good question.
If you wait until September.
This guy really wanted to
not a word that we have in our business. So we get a lot of data between now and September, and it isn't going to be one data read or even two. It's going to be the totality of the data, all of the data, and not just it. And then how is that affecting the outlook, and how is it affecting the balance of risks? That's going to be the assessment that we do. Of course, we'll all look carefully at the employment report, but so much other data coming in and so much happening between now and the September meeting, and we'll make a judgment.
That is all right.
Edward.
Thank you, Mr. Chairman. Edward Lawrence, Fox Business. I do want to dig deeper on what Michael and what Nick were asking. There's a shift in the statement to balance between the focus between inflation and jobs. Looking at the job sides, we've seen wage data show sort of an abrupt slowing. We're hearing on earnings calls from companies like Intel abrupt layoffs. In the jobs report from the BLS, government jobs has been a leading creator. Could the government jobs as a sector hiring mask underlying weakness in the jobs report?
Well, we'll look at everything. We've seen some tendency to have a narrowing base of job creation in some months going back, but then we've had some months where job creation was broader, and also the headline number of jobs has come down. So but you look at the whole thing, and I think you do look at private demand extra carefully. To your point about government. So we'll just be looking at all those things.
So as a follow then, so could the Fed then be behind the curve? Because you said some of the reports last meeting, you said the reports could be noisy or overstated. Was there a discussion of what kind of discussion was there for a cut today? And could the Fed be behind the curve?
Yeah, so look, the objective is to balance the two risks, right? It's the risk of going too soon and the risk of going too late. We've been, we had 7 months of good inflation data at the end of last year. We said we wanted to see more. We said that we pointed out that too much of this was coming from goods, and sure enough, the first quarter wasn't great inflation data. Now we've got a quarter that is good, and we're balancing the risk of going too soon against the risk of going too late. That's what we're doing. There's no guarantee in this. It's a very difficult judgment call, but this is how we're making it. But in terms of today, your question about today, we did have we had a nice conversation about this issue today. The overall sense of the committee, as I mentioned, is that we're getting closer to the point at which it'll be appropriate to begin to dial back restriction, but we're not quite at that point yet. We want to see more good data. The decision was unanimous. All 19 participants supported it. But there was a real discussion back and forth of what the case would be for moving at this meeting. A strong majority supported not moving at this meeting. That was a strong sense of the committee, but it's a conversation that we had today. Certainly.
Courtney.
Courtney Brown from Axios. Thank you for taking our questions. When the Fed was raising rates, there was a lot of conversation about long and variable lags. I wonder if that applies on the way down too. How are you and the committee thinking about that?
Yes, it does. And I think the lags have kind of showed up here in the last 6 months, by the way. You really do now see the restriction. Whereas, even a few months ago, people were questioning how restrictive policy was. Look at the labor market now. You can see, and look at inflation, rate-sensitive, interest-sensitive spending. You really do see now that policy is restrictive. I wouldn't say it's extremely restrictive, but it's certainly effectively restrictive. Yes, the lag should be on the way down. It should take some time to get into the full economy, affect financial conditions, and that affects economic activity, hiring, and that kind of thing, and ultimately inflation. It's not instantaneous, although it's faster than it used to be because markets move now in anticipation of our moves.
So are you worried then that if monetary policy acts with long and variable lags, even when you're lowering interest rates, it might be too late for the Fed to help stave off any kind of slowdown in the labor market or broader economy?
Yeah, we have to worry about that. You're just to make it clear, it's a very difficult, challenging judgment, and we don't want to go too soon. We don't want to go too late. But this is how we've made that judgment. I feel good about where we are. We're certainly very well positioned to respond to weakness with the policy rate at 5.3%. We certainly have a lot of room to respond if we were to see weakness. That's not what we're seeing, though. What we're seeing, look at the first half growth numbers. Look at PDFP at 2.6% for the first half. It's not signaling a weak economy. It's also not signaling an overheating economy. Labor market, admittedly, the unemployment rate has moved up 0.7, and we're seeing we're seeing a normalization there, but wage increases are still at a high level. Unemployment is still at a low level. Layoffs are very low. Initial claims have moved up, but they're pretty stable and they're historically not high at all. So the total scope of the data suggests a normalizing labor market. And again, we are carefully watching to see that continues to be the case.
Victoria.
Hi, Victoria Guida with Politico. On the labor market, I was wondering, how worried are you all about unemployment rising to the point where it triggers the SOM rule? And would that potentially affect how quickly you cut rates?
So I would just say that the question really is one of, are we worried about a sharper downturn in the labor market? So, and the answer is we're watching really carefully for that. We're aware of that rule, which is really I would call it a statistical thing that has happened through history. A statistical regularity is what I'd call it. It's not like an economic rule where it's telling you something must happen. So again, what do we see? What are our eyes telling us? We look at all the things we're seeing, and what it looks like is a normalizing labor market. Again, job creation at a pretty decent level, wages moving up at a strong level, but coming down gradually. Job vacancies have come down, but they're still high by historical standards. So again, I've been through some of the data already, but what we think we're seeing is a normalizing labor market. And we're watching carefully to see if it turns out to be more, it starts to show signs that it's more than that, then we're well positioned to respond.
Is there a reason to think that the labor market might behave differently this time than it has historically?
I think, history doesn't repeat itself. It rhymes. I think that statement is very true about the economy. You never assume it's going to be just the same. An example would be, is there a trend increase in the level of vacancies? There are many, many examples. So it's never exactly the same. Also, let's remember that this pandemic era has been one in which so many, apparent rules have been flouted, like the inverted yield curve, for starters. So many pieces of received wisdom just haven't worked. And it's because the situation really is unusual or unique in that so much of this inflation came from the shutdown in the economy and the resulting supply problems in the face of admittedly very strong demand. So the whole situation is not the same as many of the other prior inflation or downturns that we've seen, or business cycles that we've seen. So we're having to learn, we're having to, to be very careful about the judgments that we make, I would say. So we don't assume that these regularities will just repeat themselves automatically.
Amir.
Thank you, Chair Powell. I'm Mara Mokwe with Bloomberg. There seems to be quite a difference between what the anecdotal data are telling us, such as the very recent downbeat beige book, and the hard data. Do you take those anecdotes seriously? That is, that the economy and labor market are cooling much more rapidly than what's shown in the data?
So I do take that seriously, and the beige book is great. What's even greater is hearing the Reserve Bank presidents come in and talk about their conversations with businesses and business leaders and workers and people in the nonprofit sector in their districts. But I'll tell you, it's a pretty, the picture is not one of a slowing or, a really bad economy. It's one of, there are spots of weakness, and there are regions where growth is stronger than other regions. But overall, it's, again, look at the aggregate data. Aggregate data is, particularly PDFP, private domestic final purchases, is 2.6%, and that's a good indicator of private demand. So we listen to all of that, and it does. I think it's important to listen to anecdotal data and not just look at the aggregate data. Especially, it's very hard. GDP data can be volatile quarter to quarter, so it's just hard to measure economic activity. There are a lot of. It's just difficult to do. So I look at both. Yeah, but I wouldn't say that the anecdotal data is uniformly downbeat. It's more mixed.
Lots of breakout there.
Thank you.
Jolene Kent with CBS News. Chair Powell, thanks for taking our questions today. You have consistently said that the Fed does not consider politics in making decisions.
Here we go.
With a possible September rate cut on the table, it would be less than 2 months before the election, and former President Trump reportedly said that cutting rates so close to the election is something the central bank knows they shouldn't be doing. What's your response, and do you believe it's possible to really remain apolitical with a September rate cut?
I absolutely do. And I think it's, first of all, we haven't made any decisions. I would say it this way. Haven't made any decision about any future meeting. I don't know what the data will reveal or how that will affect the appropriate path of our policy. I really don't know. I do know how we will make that assessment. That's what I do know. So if you take a step back, the current situation again is inflation has come down much closer to our goal, and that's happened while unemployment has remained low. We're very tightly focused on using our tools to try to foster that state of affairs continuing. That's at each of our meetings and all of our decisions, our focus is strictly on that and really on nothing else, doing our part, whatever that part may be. We're using our best thinking. We're doing our best to understand the economy. We follow academics. We follow the many commentators who bless us with their commentary. But we don't change anything in our approach to address other factors like the political calendar. Congress has, we believe, ordered us to conduct our business in a non-political way at all times, not just some of the time. I'll say this too. We never use our tools to support or oppose a political party, a politician, or any political outcome. The bottom line is, if we do our very best to do our part and we stick to our part, that will benefit all Americans. If we get it right, the economy will be stronger, we'll have price stability, people will find jobs, wages will rise in real terms, everyone will benefit. So that's what we believe, and that's how we will always act. This is my 4th presidential election at the Fed. I can tell you this is how we think about it. This is what we do. So anything that we do before, during, or after the election will be based on the data, the outlook, and the balance of risks, and not on anything else.
Just a quick follow-up. Do your economic forecasts and models take into account the two very different economic plans of these two presidential candidates, Harris and Trump? And if so, how?
No, we do not do that. We absolutely do not do that. We don't know who's going to win. We don't know what they're going to do. We don't act as though we know, and we just can't do that. We basically have our forecast. We can run simulations of different potential policies, but we would never try to make policy decisions based on the outcome of an election that hasn't happened yet. That would just be a line we would never cross. We're a non-political agency. We don't want to be involved in politics in any way, so we wouldn't do that.
Nicholas.
Thank you, Chair Powell. Nicholas Jasinski from Barron's Magazine. There hasn't been a dissenting vote on an interest rate decision in some time. If the data do evolve as you expect, if you do have more confidence by the September meeting, do you get the sense that there will be a unanimous vote on an interest rate move in September? Or basically, are there meaningful differences in committee members' assessments of how much more confidence is needed?
So there are always meaningful differences. There are, and we talk a lot before, during, and after the meeting. We do have a very robust discussion of these things. You're right that in most cases, people, if they feel heard and they feel that their position has been given serious consideration, for most people, most of the time, that's going to be enough. There are dissents. That's fine. No one has a veto. No single person has a veto. So it just is a question of who will vote for and against. We've had dissents. We haven't had so many during the pandemic era, and it just may be that we've felt more united because we felt under a lot of pressure to get things right. But before the pandemic, we had plenty of dissents, and dissents happen. It's part of the process. There's nothing wrong with dissents, and if it happens, it happens.
Jean.
Hello, Jean Young with M&I Market News. Is a 50 basis point cut as a first cut at all likely or even on the table? Thank you.
I don't want to say, I don't want to be really specific about what we're going to do, but that's not something we're thinking about right now.
Oh, he knows.
Jennifer.
Of course, I haven't made any decisions at all
See?
as of today.
See?
Thank you, Chair Bell. Jennifer Schonberger with
That
the
was
Finance.
important. He knows.
Not to get into the minutes, but you said there was a real discussion today for moving at this meeting. I'm curious if you could provide some more color on the nature of the discussion today at the meeting about a possible rate cut as early as September.
He knows.
Well,
You don't say that's not what we're going to do. Be like,
you know,
well,
the
we
way the
haven't made
meeting
any
is set up,
decisions. He knows.
the first day there's a discussion of financial stability because it's every other meeting we have that, and then we have an opportunity to comment on that. Then we have an economic go around, and then this morning we have the monetary policy go around. And I think in people's economic go around and in their monetary policy go around, people express their views about this, and there's a range of views. People, as you will know from the speeches that they give, people have different ways of thinking about the economy, and so in the minutes we'll lay this out in a much better way than I can do off the cuff. But there's a range of perspectives, and but I do think that we're a consensus-driven organization. People come together. This was a unanimous decision, and at the end, everyone supported the outcome, not just the voters, but everyone. So I would also say some people examine the possibility, the case for moving at this meeting, but overwhelmingly, the sense of the committee was not at this meeting, but as soon as the next meeting, depending on how the data come in.
But there is a growing sense of confidence that you could move at the next meeting, assuming inflation comes.
Well, assuming that the totality of the data supports such an outcome, no question that is the case. That as I mentioned, we think that the time it's approaching, and if we do get the data that we hope we get, then a reduction in our policy rate could be on the table at the September meeting.
Hi, Chair Powell, Nancy Marshall-Genzer with Marketplace. Former New York President Bill Dudley wrote an op-ed in Bloomberg earlier this month, which you probably saw, in which he said, quote, "It might already be too late to fend off a recession by cutting rates. Dawdling now unnecessarily increases the risk." Is he wrong?
So this is the judgment that we have to make, and we're well aware of the judgment. We're as I've said, we have to weigh the risk of going too soon against the risk of going too late. If we go too soon, we can, we had a lot of advice, to go ahead and cut after the 7 good months of last year. We didn't. We said we needed to see more. Then we saw some higher inflation. We've seen 1 quarter of good inflation, and we've seen the labor market move quite a bit. And as I mentioned, I don't think it needs to, cool off anymore for us to get the inflation results that are related to the labor market. Not all inflation is, of course. So I think it's a difficult judgment to make, and what you see is the judgment of the committee is that time is drawing near. That time could be in September, if the data support that.
And have the chances of a hard landing increased?
So I don't know whether they've increased. I think they're low. I think this is, you don't see any reason to think that this economy is either overheating or sharply weakening. That's just not in the data right now. What's in the data right now is an economy that's growing at a solid pace, a labor market that has cooled off, but nonetheless, unemployment is low. The data overall show a strong labor market. So that's really what you see. It's neither an overheating economy nor is it a sharply weakening economy. It's kind of what you would want to see, but of course, the job is never done. We're watching to see, which way the economy heads, and I think if we are to respond to weakness, we're certainly, well equipped to do that. But that's not what we're seeing. What we're seeing is strong economic activity and a good labor market and inflation coming down.
Greg.
Thank you so much. in the minutes of the June meeting that came out a few weeks ago, there was a discussion about communications, and some Fed officials said maybe the Fed wasn't as clear enough about its reaction function. And when I talk to the commentators who bless you with their comments, they say that they really don't have a sense of what is going to judge, maybe not the first cut, but the pace of the cuts going forward. They don't have a good sense of that. Is there anything you can say, like, how will we judge that?
Yeah, I mean, I think the reality is that forecasters, and this isn't just the Fed by any means, forecasters have been continually surprised by, for example, the strength of the economy last year. So I think we had to be pretty humble about giving forward guidance about this, that, and the other thing. We need to be pretty careful about that. And
Well,
you know, when you're saying you're going to be data driven, of course, it's always what the data, how they affect the outlook and the balance of risks. But nobody has great vision deep into the future. In terms of a reaction function, that's a long time, discussion that people have had forever. I think people have understood for a long time, actually, that we were very focused on bringing down inflation. Nobody was really confused about that. The data have, again, you've seen significant improvement in inflation just for the last quarter. Markets move around on the data, really, not so much. It's not really what we're going to do. It's more just that the data keep coming in, and markets are very, very responsive to that data right now.
It's edgy.
Go to Jeff for the last question.
Thank you, Mr. Chairman. I'm going to change gears on you just a little bit from all of the rate talk and whatnot. With Fed now being in the books for a little over a year, there hasn't been a whole lot of talk about central bank digital currency, and wondering if you could give us an update on where things are with that. Is that considered a dead issue now? Is it still something that's being discussed within the committee, and what's happening with that?
It's not something that comes up at all in the FOMC. So more broadly, digital finance is an area that has really significant implications for payments generally, instant payments, and it's something that's going to really change the way it's going to make more efficient and hopefully safer and all those things, the way payments are made around the world. And so we have people who are researching that and trying to keep up to speed, because we play an important role in the payments sector, both as a convener and as an operator too. In terms of a CBDC, there's really nothing new going on. There's not much going on at all. We don't have the authority to issue a retail CBDC that's available to the public. We're not seeking that authority. So what we're doing is keeping up with developments there. Pretty much every major central bank in the world is at least doing that. Some of them are actually seriously looking at implementing a CBDC. We're really not. We're really just evaluating, the story and what's happening out there. I think it's work that we need to be doing, which could be very beneficial down the road. But we don't have on a CBDC. We don't have any plan. We would need to go to Congress, and we have no plan to do that. No one here has decided that we think it's a good idea yet. Thank you.
All right, ladies and gentlemen, that was the FOMC meeting. So a lot of crazy things going on. I mean, the market, it wasn't a dud. I mean, it popped. I'm still looking for NEE to make that new high over here to break this level. DRN looks good. That BIPC that broke out when we were on the stream here, that thing looks really good. But team, we're going to be live again tomorrow at 9 a.m. Eastern as usual. So again, make sure you guys have notifications turned on for the channel so that obviously you guys can come back to the streams if you guys want, calling out stocks that are about to explode before they do. So, and again, you guys have until midnight tonight. Those of you guys that have not hopped in for the 40% off deal, to all the education, the watch list, the direct access to me to make sure that you guys are actually putting yourself in the best position to have long-term success in the market. But most importantly, that's going to get you free access to the premium Discord when it does launch at the end of August. So in August, the discount is going to be 20%, not 40%. So if you guys do want to take advantage of that, I mean, you guys have seen the countless testimonials there. If you guys are interested, hop in and put yourself on the winning team. So everybody, great day. I mean, let's see what happens going into the end of the day. Market sold off right after Powell here. So, I mean, that's to be expected after being up like 2% on the day. Facebook earnings after hours today will be very interesting. We have the jobs report tomorrow morning. What else do we have? And then tomorrow after hours, lots of earnings coming out, lots of earnings. And then Friday's huge with NFP. So we're going to have a really fun rest of the week. We'll be live early Friday for NFP. So we'll be on at like 8:25. So Fridays, when we do have data like that, like a PCE or NFP, I do come on a little bit earlier. But again, another good day. Let's see if NEE can continue. The DRN's coming down a little bit, but still nicely green on the day. Market kind of losing steam a little bit here, but I mean, that should be expected. So team, I'll throw that link in here one last time. The discounts STV40. So those of you guys that's something to hop in, there you go. But I will see you guys tomorrow. You guys have a great rest of your evening.